Have you ever noticed that the people who seem the richest are often the first to panic when the economy slows down? They own luxury homes, expensive cars, and businesses that look unstoppable. But when cash disappears, everything they built suddenly begins to fall apart. The strange truth is that wealth doesn't usually disappear because people stop making money. It disappears because they run out of cash. And once you understand why, you'll never look at money the same way again. On a cold Monday morning, a businessman walked into his office, wearing the same confident smile he had worn for years. His company was worth millions on paper. His house had doubled in value. His investments looked impressive. Everyone around him believed he had already won the game. Employees admired him. Friends envied him. Banks were happy to lend him even more money. But hidden behind every success story was a secret nobody else could see. Every month, massive bills arrived: loan payments, salaries, rent, suppliers, taxes. Every dollar that came in already belonged to someone else. His empire looked enormous, but underneath it stood on a foundation far weaker than anyone imagined. Then something happened that changed everything. The economy slowed just enough to make customers hesitate. Sales didn't disappear overnight, they simply became slower. Payments arrived later than expected. New deals were delayed. At first, nobody seemed worried. The businessman told himself it was temporary. His managers remained optimistic. Investors still believed the company would recover. After all, they had survived difficult times before. But businesses rarely collapse because of one dramatic event. They collapse because of 1,000 tiny problems arriving one after another. And the real problem was just beginning. While everyone focused on profits, another number quietly became more important than anything else: cash. Not future revenue, not company valuation, not assets. Actual money sitting in the bank account. Every morning became a race against time. Which bills could be paid today? Which payments had to wait? Which supplier would become impatient? Which employee might leave if salaries were delayed? Suddenly, the businessman realized something terrifying. His company wasn't dying because it lacked opportunity. It was dying because it lacked liquidity. What happened next shocked everyone. For decades, people have been taught to admire wealth that can be seen: bigger houses, faster cars, luxury vacations, expensive watches, huge investment portfolios. Social media made this obsession even stronger. Success became something people photographed instead of something they protected. Almost nobody posted pictures of a healthy cash reserve sitting quietly in a savings account. It looked boring. It wasn't exciting. Yet, that invisible pile of cash often determined who survived financial storms and who disappeared forever. History has repeated this lesson over and over again. During every major financial crisis, from recessions to market crashes, one group of people always seems to emerge stronger than before. It isn't necessarily the smartest, it isn't always the richest. It's the group that has cash available when everyone else is desperate. While others are forced to sell valuable assets at terrible prices, people with cash suddenly have choices. They aren't controlled by panic, they negotiate from strength. And in finance, having choices is one of the greatest forms of power. Think about what happens during a housing crash. Families who borrowed too much suddenly face impossible decisions. Mortgage payments continue even as property values fall. Some are forced to sell beautiful homes for far less than they paid. Buyers with cash walk into the market while fear dominates everyone else. They don't need permission from banks. They aren't waiting for complicated loan approvals. They move quickly because they prepared long before the opportunity appeared. This single difference changes entire fortunes. The same pattern appears in the stock market. During bull markets, almost everyone feels like a genius. Prices rise, portfolios grow, confidence becomes addictive. Investors begin believing that cash is useless because markets only seem to move upward. Holding cash suddenly feels like missing out. Fear of missing opportunities becomes stronger than fear of losing money. Many invest every available dollar. Some even borrow to invest more. The excitement feels unstoppable. But nobody could have predicted what came next. Then the market falls. Not a small correction, a real crash. News headlines become darker every day. Fear spreads faster than facts. Investors who once promised they would never sell begin dumping quality investments simply because they need money. Margin calls force people to liquidate positions. Businesses reduce spending. Banks become cautious. The same assets everyone desperately wanted only months earlier suddenly become unwanted. Yet somewhere, someone quietly opens a brokerage account filled with cash. While others panic, they begin buying. This isn't luck, it isn't magic, it's preparation. Cash gives people something panic cannot buy: time. When you don't desperately need money tomorrow, you make better decisions today. Pressure disappears, emotions become manageable. You stop reacting and start thinking. The difference between fear and confidence often isn't intelligence, it's liquidity. One of the greatest investors in history has repeatedly emphasized the importance of keeping enough cash available even when opportunities seem endless. Many people misunderstand this philosophy. They believe cash earns little compared to stocks or businesses. Sometimes that's true, but cash has another purpose that isn't measured only by returns. It provides optionality. It gives you the ability to act when everyone else cannot. That hidden advantage becomes priceless during moments of uncertainty. Imagine two entrepreneurs with equally successful companies. On paper, both appear identical. Revenue is growing, customers are happy, employees are motivated, investors admire them. Then, an unexpected crisis hits. Sales fall by 40% for 6 months. The first entrepreneur immediately begins laying off workers, selling equipment, delaying payments, and accepting terrible financing just to survive. The second quietly continues operating because years earlier they built a large cash reserve. Customers barely notice the difference. Employees remain loyal. competitors begin struggling. 6 months later, the second entrepreneur starts buying weekend competitors at incredible prices. The crisis becomes an opportunity instead of a disaster. This is the part of finance that rarely becomes viral online. Nobody celebrates emergency funds. Nobody boasts about liquidity during bull markets. Cash feels slow. It feels ordinary. It doesn't create excitement. But financial freedom often looks surprisingly boring, while financial disaster usually begins with excitement. The pressure to always stay fully invested has become stronger than ever. Financial influencers constantly discuss maximizing returns. Friends compare investment gains. Headlines celebrate people who turn small investments into fortunes. Very few people talk about those who quietly survived every downturn because they refuse to gamble everything. Survival rarely makes headlines, bankruptcy does. Businesses understand this lesson better than many individuals. Large corporations often hold billions in cash, even while earning strong profits. Some critics question why they don't invest every dollar immediately. The answer becomes obvious during uncertain times. Companies with strong balance sheets continue hiring while competitors fire employees. They continue investing while others cut budgets. They negotiate better deals because suppliers trust financially stable customers. Confidence grows because cash removes desperation. Desperation changes behavior in dangerous ways. When people desperately need money, they accept terrible jobs, bad business deals, expensive loans, risky investments, and unfair partnerships. They lose negotiating power because the clock is working against them. Every decision becomes urgent instead of intelligent. Cash quietly reverses that relationship. Suddenly, you can say no. Suddenly, you can wait. Suddenly, you can choose. But the real danger isn't having too little cash, it's believing you'll never need it. Success creates confidence. Confidence slowly becomes overconfidence. Expenses increase. Debt grows. Lifestyles expand. Businesses become larger. Responsibilities multiply. Everything feels manageable while money keeps flowing. Then one unexpected event changes everything: a recession, a health emergency, a major client leaves, technology disrupts an industry. The unexpected rarely sends an invitation before arriving. Think about the pandemic. Around the world, millions of businesses experienced something they had never imagined. Revenue disappeared almost overnight. Restaurants closed. Airlines stopped flying. Hotels emptied. Retail stores locked their doors. Companies that had looked incredibly successful only weeks earlier suddenly fought for survival. Some disappeared forever. Others survived because they had enough cash to withstand months of uncertainty. Their products hadn't changed. Their employees hadn't changed. Their leadership hadn't changed. One number changed everything: cash reserves. Ordinary families experience the same reality. Some households lost income but remained calm because they had emergency savings. Others entered panic within weeks because every paycheck had already been spent before it arrived. The emotional difference was enormous. One family focused on solving problems, the other focused on surviving until tomorrow. Financial pressure affects every decision people make. Interestingly, cash also protects investors from their own emotions. During market crashes, fear convinces people that prices will never recover. During bull markets, greed convinces people prices will never fall. Cash acts like emotional insurance. It reminds you that survival matters more than excitement. It creates patience in moments when everyone else loses theirs. The richest opportunities often appear when confidence disappears. Businesses sell for less than their worth. Stocks become undervalued. Real estate becomes negotiable. Skilled workers become available. Partnerships become possible. But only people with available capital can take advantage of these moments. Everyone else watches from the sidelines, wishing they had prepared differently. This creates one of the greatest paradoxes in finance. The people who seem cautious during good times often become the boldest during bad times. Why? Because preparation transforms risk. Buying during a crash looks fearless from the outside. In reality, it becomes possible only because discipline existed long before the crisis began. Another mistake quietly traps millions of people. They confuse net worth with financial security. Someone may own assets worth millions while having almost no available cash. Another person may have fewer assets but significant liquidity. During stable markets, the first person appears wealthier. During crises, the second often sleeps better. Markets eventually reveal the difference. Banks understand this better than anyone. They happily lend money when you don't desperately need it. The moment you truly need financing, approvals become harder, interest rates become less attractive, and conditions become stricter. Depending entirely on borrowed money creates invisible risk. Having your own cash reduces dependence on other people's decisions. There is also a psychological power that money in the bank quietly creates. Confidence no longer comes from appearances, it comes from resilience. You stop chasing every opportunity because you know another one will come. You stop making decisions from fear because your future isn't hanging by a single paycheck. You become harder to manipulate because urgency loses its grip over you. That doesn't mean cash should remain idle forever. Money should work. Investments matter. Businesses create wealth. Stocks build long term prosperity. But every successful strategy needs stability beneath it. Cash is not the enemy of investing. It is the foundation that allows investing to survive difficult times. The greatest financial disasters often begin with a simple sentence: nothing can go wrong. Every bubble in history has whispered those words. Every over leveraged investor believed tomorrow would look like today. Every failed business once felt unstoppable. Confidence is valuable. Blind confidence is expensive. Imagine standing in front of two bridges crossing the same river. One bridge looks beautiful but has weak foundations. The other appears ordinary but was built to survive storms. During sunny weather, both seem identical. Only when powerful winds arrive does everyone discover which bridge was actually strong. Cash works the same way. Its value becomes obvious only after uncertainty begins. The world constantly encourages people to spend more, borrow more, invest more, and display more. Very few voices encourage patience. Very few celebrate resilience. Yet, resilience quietly determines who remains standing after everyone else has fallen. Years from now, you probably won't remember the hottest talk everyone was talking about. You may not remember which cryptocurrency briefly dominated headlines, but you'll remember how financial pressure felt during difficult moments. You'll remember whether you had options or whether circumstances made every decision for you. The true power of cash has never been about earning the highest return. It has always been about buying something far more valuable: freedom. The freedom to wait, the freedom to negotiate, the freedom to survive, the freedom to invest when fear controls everyone else, the freedom to say no when desperation demands yes. Money invested wisely can build wealth. Businesses can create fortunes. Real estate can multiply assets. Stocks can change lives. But cash quietly protects all of them. It is the invisible shield behind every lasting fortune. And perhaps the greatest secret in finance is this: the people who seem to have the least exciting strategy are often the ones still standing when the excitement is over. Because real financial power isn't measured by how much money you can make when times are easy. It's measured by how many choices you still have when times become hard.